In today's video, we're going to take a look at some research behind momentum investing or trading. This is Michael Thompson, Equity Advisor and Analyst at JB Markets. Before we do so, just to cover the general advice again, anything we cover today is going to be for educational purpose and doesn't take any of your personal circumstance or situation into consideration. And past performance is not a reliable indication of future performance. So the actual report I'm going to cover today, or the research I mean, is going to be specifically one that covers 1 century or 100 years of research based on momentum. It's one that's done by a hedge fund called AQR Capital. Now, this was done back in 2014. How it's very relevant. It's still there is one other one that's come out after this. It covers 200 years. I want to cover this one because this is one's quite insightful, and the momentum actually that they did to do the testing is quite simple. So the study itself is done by Brian Hurst and Yao Hua Hun, if I pronounced correctly. And as I mentioned, it's run by the hedge fund AQR Capital, which they did this research back in 2014. And the summary as we go, I'll highlight that it covers trend following strategy, which is a momentum base, and it goes across global markets since 1880, and it goes to show the evidence with more than 100 years behind this strategy or this concept itself. The whole idea within trend following is to deliver strong positive returns and realize low correlation traditional asset classes, such as your stocks and bonds. Now, I won't go through all the detail, it won't take too long in this video, but we'll go through and highlight the most important area. So the introduction of it is that some 200 years ago, classical economist David Ricardo was touting how to cut short losses and also let your profits run on, which is really the basis for momentum trend following strategies. Then a century later, legendary trader Jesse Livermore, if you've been involved in the markets long enough, you'll come across Jesse Livermore as a well-known name and a figure in the trading world. So Jesse Livermore came into the scene, and he was saying the big money was not made on the individual fluctuation, but in sizing up the entire market and its trend. So essentially trying to capture the trends and follow them. Now the basic premises of trend following strategy is to go long when markets are positive or rising, and to go short when markets are negative or falling. Now the whole series momentum strategy has been really profitable since 1985 on most asset classes, and we'll go through and have a look at that. So in terms of the performance, they've noticed that it's not a statistical fluke. It's not something that just happens to be something that's anomaly. It's shown to be robust and a robust phenomenon or concept, and has existed over a large range of economical conditions. So going back to 1880, it's been consistently profitable for the last 135 years. Now, the most important thing about this particular strategy is that it does really well during periods of turmoil, such as during the GFC 2008 crisis. It was quite profitable and has low correlation to the general asset class like equities and bonds. Now, how they constructed it, this is the basis of what they determine what is an uptrend or what is a downtrend, to better generate buys and sell or rules to enter and exit the market. So they go both sides. So we're talking about taking a long position and shorting the market. So how they did that is they constructed a very simple way to determine that. They simply look at if the price was positive, if they look back over equally weighted over 3 different time frames. So 1 month. So if the price, let's say, was $10 this month, and they go back 1 month, and the price was $9, that was a positive increase. So that means that it was in an uptrend. They look back 3 months and then 12 months. So they equally weight them, and then the end result was used to determine it was positive, they would go long. It was negative, they would go short. They did that across 67 markets and 4 major asset classes. Now, It's not on individual stocks, but it'll give you an idea because they cover 29 commodities, 11 equity indexes, which is the overall market, 15 bonds market, and 12 currency pairs. So really across the spectrum. And in terms of the data, what they did use is when it was available. If you haven't traded futures, that's a common market that's traded with a lot of the hedge funds. They're trading the futures market. Where they didn't have that, they would rely on the cash index in order to replicate that period, because markets came in line or tradable at different time frames. But they were trying to replicate this on the indexes, so that if they had no data for the futures market. So here, they've noticed that, as I mentioned, they will look for a long a buy when the trend is rising, or positive returns, and negative returns means they would go short. So in that case, they were always long or short, which means that they were always in the market. So really, they weren't picking just times of to go into cash. Because of these basic rules, they were either long the position in an instrument or futures contract, or they were short. Now, to replicate a volatility target, or to reduce the risk side of it, they had a target volatility of 10%, and they adjusted their position or the allocation of capital accordingly to reach that target, so they evenly distribute the risk across the different markets. So what that means that let's say oil was more volatile, twice as volatile as, for example, gold. Not gold's probably a good example. Let's say stock market index, S&P. Gold would have, oil would have half the contract compared to an index futures contract. So what they're trying to do is evenly distribute the risk, and then also at the same time, after doing that, having the target of 10% volatility, they also would adjust it for cost, which means typically in the investment hedge fund industry, it's usually 2% management fee and a 20% performance fee with a higher watermark, which means they have to perform above the previous high they've achieved on the fund before they can get paid. Now let's scroll down here and have a look at the results. So this is the results going back with the 22 and 20, known as the 2 and 20 fee, and you can see the period every 10 years, every decade was covered there. So the overall performance, you can see here, annualized gross of fee was 14. I'm just going to reduce this a little bit. It was 14.9%. With the fees taken out, it still averages quite a good return of 11.2. Now, bear in mind, this goes back over 100 years. So it's really data, which is known as hasn't been done before. So they're really applying research is what he calls unseen data. So they've done it to, these hedge funds have really been around since, is probably well recognized, around the 80s, 70s, 80s was when the most predominantly in hedge fund was very started to establish themselves in the industry. Prior to that, there wasn't really any hedge fund at all. And you can see, even going back that time frame, the returns are still quite good. There's the volatility, which they were targeting. And you can see the correlation, which is the important part of this column here. Correlation is quite low, or in some cases negative, which means it's good to add it into an equities portfolio or bonds. And here's the bonds correlation here. So the lower the number, the better it is in terms of adding it to a portfolio so that you get diversification. And that's the whole aim of having these particular markets and this strategy, is to have the diversification approach. So you can see that the performance has been remarkably consistent over the extended period time horizon, including great recessions, multiple recessions, and expansions, multiple wars, stagflation. So all the major big events throughout the last 100 odd years, it has performed reasonably well and exceptionally consistent. Now, price trends in the past tends to be along, what they've noticed that in terms of the return is true that price trends tend to exist as a long-standing behavioral bias, which is exhibited by investors. So the market's made of investors and traders that exhibit certain behavioral biases, and this behavioral bias generates these trends, which is what they're saying. So as well as trading trading activity of non-profit taking participants such as the central banks, so intervention by the central bank, and corporate hedging programs. So because they're based on these commodity and futures market, a lot of hedging, big institutions trying to protect their position, these build these trends that they can take advantage of, this strategy can take advantage of. We'll go skip to the next one. This is the distribution of its return compared to the US markets in terms of the correlation. So we move on to the next part, which is really an important part of it, is the non-correlation, the low correlation, I mean here. So you can see this is all the major significant corrections or drawdowns, which is the biggest drop in the market compared to owning 60% in stocks, so 60-40 split. So the typical stockholder account, let's say, has 60% in stocks and 40% in bonds. Now compared to the momentum research that they did. So the green one is the trend following. The purplish color, blue purplish color is for the 60-40 allocation. As you can see, the 1983, the panic of 1983, the momentum strategy was positive, where holding a 60-40 was negative losses or took a hit. Then you had the panic of 1907, similar situation, but the profit was larger for the trend following. World War I, same scenario, positive return for trend following, and negative obviously during that period. Then you had the Great Depression of 1929. The market took a really big hit. That was over a 50% correction, where the trend following made, just judging off the graph, looks like around 35 to 40% return. And then the 1937 recession, the trend following model took a little bit of a hit, but not as much as the actual 60-40 portfolio. And you can see the stagflation, oil crisis, and then up to the most recent financial crisis here. What's important to note is that because you're taking a short position on the way down, you can be very profitable on the way down when market corrects. So these are all the major events, and this is an illustration of why using trend following, even in events of crisis, can be very profitable. If you're not taking a short, what most likely will happen is you will go flat. So if you were buying stocks, for example, as comparison, the way trend following would work is that if you were long only, you would be flat that period and you wouldn't have to take these large hits. In some cases, you'll take a small hit and then you'll go to cash. But if you're shorting, you obviously have the advantage of profiting on the way down. So here, out of the biggest major events that occurred, there were positive returns 8 out of 10 of these major crises. So 8 out of those 10 periods, you're profitable. Of the 2 times you weren't profitable, you took a small loss compared to a very large loss when the market was tanking or selling off really hard. So that's that 1937 event and the 87 crash. Well, all the other periods were profitable. Now this is just an illustration what they're saying. If you have 60% diversification and then 60% to the stocks and bonds, and then 40% allocated to momentum strategy. You can see the 60-40 is a general stock one, and then you can see if you allocate up 20% to time series momentum, which is a momentum strategy, you can increase your return while reducing your volatility and also your drawdown, the losses on the account. So what they're simply trying to put in this paper is that if you had all your money in this 60-40, you wouldn't fare so well. But if you were just to put even 20% into the momentum strategy, you're able to reduce your overall drawdown. All the metrics improved because of the diverse nature of the strategy and the markets that it trades. These are all the major drawdowns that occurred for the momentum strategy over that duration, highlighting the biggest losses starting from the top here. So in the 1947, these were the losses that occurred. The highest one was 26.3% compared to the market, which you will notice in these great recessions or period could be as much as 60 to 70% during that same period. And also highlighting how long it takes to recover, how long they were, because with regards to losses in the account, there's really two questions. How deep was the loss and how long did it take to recover? And this is just showing how long it took to get back to that level. Now the strategy outlook in terms of what their conclusion was moving forward. There's been a lot of money pouring into trend following and systematic strategies, which is what really trend following is. It started with a 22 billion investment in 1999 and it went to over 280 billion in 2014. Growth has been quite substantial. So due to the more recent conditions, the last probably 5 years, the strategy performed well, possibly due to the fact there is more money pouring into space. Regardless of the size of the space, it's not as big as the overall market. It still remains small relative to the general long-term just buy and hold strategy. So they're saying that in terms of the outlook, that could be a consideration as to why the strategy could be underperforming in the last 5 years or so. And that could be the weighing on the strategy because of a lot more money managers and hedge funds going into it. Also, they've noticed one thing with correlation. This is the correlation of the pairs in the basket. So let's say comparing gold, indexes, currencies. Now, the average correlation was around 0.2 historically since 1880. What happened in the more recent 5 years to 10 years or so, the correlation has been going higher. There could be a number of considerations that can occur. The most probably important thing is that trading became electronic. A lot of those markets were known as the pits, so it was very manual. Orders were done by tickets, were guys yelling prices, buying, selling. When the markets came online, and because of globalization, how it works, all markets are very interconnected now. That could be the reason for the higher correlation, which is what they're saying there in the summary. And that also causes the effect of lower returns because markets are moving in a similar direction. So that means that for diversification, you don't have that improvement of having those additional markets. But more recently, they've seen that the correlation has come back down. So it signifies there's a good chance that these markets the strategy will perform much better due to the correlation coming back to their normal averages, which is around about 0.2. So the other thing is that the third part I mentioned is our transaction costs. So this is a positive thing, part of the outlook, is that transaction costs has come down. Trading 20, 30 years ago, before electronic markets were online and more efficient, trading costs can add into, obviously, profits. And these were the consideration that occurred maybe 20 years ago, but now that markets are becoming very efficient, all electronic now, a lot of volume goes through the markets electronically. So what that simply means is that costs has come down, and that means returns can improve simply by costs coming down, plus managers are lowering their fees to become more attractive. Instead of charging the 2 and 20, they're charging less. Some managers are charging 1% for their fees, lowering their fees, making them more attractive for new investors. And their 20% fees in some cases have come down as well. Now the overall fourth part of their outlook is that the strategy by its very nature is diversification. It diversifies across different markets, and for the very fact that it goes long and short based on looking for identifying trends on the upside and on the down on the breakdown, means that if you're holding stocks only, this is a great way to diversify regardless of any other factor, because the strategy by its very nature buys strength and sell weaknesses, and it trades in markets that most investors aren't invested in, is a great way to diversify. So that's that conclusion part. We'll come to the conclusion now. So the overall strategy itself has performed consistently well, given the fact that a lot of these markets, or these trend following as a strategy, as a investment strategy for the hedge fund or overall, has really been commercialized or been active in the market where investors have been around probably in the hedge fund side, probably around the 50, 60 years. So going back over 100 years means a lot of the markets have been unseen. So they're out of market samples, so to speak, meaning that they're tested on markets and times that these strategies were not really prevalent and traded. So it means that it's good, significant, shows positive return, means it shows high confidence that even in times going back to 1880, the strategy has shown to perform, which suggests that there's a likelihood the strategy will likely to continue to perform. And the reason for why it performs well is really due to a number of factors. And the one they stated is that investors' behavioral biases. Markets are made of people, and the herd mentality kicks in, and you tend to find trends emerge out of that. So you've got hedging also as part of consideration, and interventions from central bank and governments can cause, for example, if the governments are buying bonds and they're propping up the market, obviously the bonds will continue to trend higher with the big buying coming from the Federal Reserve and from for intervention across the globe. So that's why trends emerge and why this phenomenon is likely to continue And that's it for the report side. This gives you, and then at the end of it, you've got the different markets they use. So you can see the indices, this is the one they've included. It covers pretty much the broad liquid markets that are common in a lot of hedge funds. So German, French, you've got Australia. So all the major and the Asian markets included there. So if you're doing individual stocks, which in our reports we do, you'll find that the principle itself doesn't change. This is just they're trading overall markets as opposed to individual stocks. And then you've got all the different listed bonds, currencies, and also commodity. So as a strategy, it's very robust. It works across different markets and allows you to capture markets moving higher or markets that are going to break down and go into bear markets. So I will include the link for this. And I hope that's been insightful for you in terms of investigating more in momentum strategies or maybe trying to develop your own one. This research is a good way to reaffirm the basis behind the strategy and give you confidence to move forward, to test some ideas, or simply to use our reports to be more confident knowing that it's backed by research and academic. There's more and more academic paper coming out, but this is probably the one that I found most relevant and useful for the time frame, and also the fact that they cover global markets, ranging from commodities, currencies as well. So in terms of the strategy, it does work on various markets for that very reason. The whole idea is by building a portfolio and having it diversified. So thanks for joining this video. Just one last thing, I'll include the link. There is another one which you do some research on Google, you'll find there's one on 200 years. We may cover that in another video, but hopefully this has been insightful, and I'll see you in the next video.